this is Rachel Marshall. Today I want to talk with you about the most effective and efficient way of financing. Now, we all have needs for financing. In our personal life, this could be buying a new car, buying a house, going on vacation, paying for your kids' education. This could be in business, maybe you're expanding into a new marketplace, or you're buying inventory, or perhaps you're even building up to a job that you will then be paid on the back end. So you have all these capital expenses right now, you need to keep the doors open, keep the employees paid, and yet your income will come after you finish the job. Any position you find yourself with the need for financing, we actually have 3 options of how we're going to pay for that. So I want to walk through the first 2 that we typically think of and then show you an alternative method. So in financing, we know that one way is to pay cash for something. We used to be in a higher interest rate environment where you could earn more like 6 to 10% on your money. And now we know that if you're saving your money in a savings account, you're earning less than 1%. So it doesn't seem very valuable to most people, given today's interest rate environment, to save their capital. So what has that put us in the position of? Not being able to pay cash. Then the other option would be finance, meaning that we go to a bank or a lending institution and we ask them for their capital so that we can use somebody else's capital. In either one of these cases, we have a cost. Now, it's very easy to see what the cost of financing is because it's interest. Now, the interest rate is one piece, but if we look at the volume of interest in the total dollars that you'll pay for the cost of that loan, we want to be aware that we have a lot of the dollars flowing out of our control. That's the cost of financing. People look easily at paying cash and say, well, I'm going to pay cash so that I don't have to pay interest. And this I hear from many people who say they don't want to be in debt, they don't like making payments, they don't want to pay interest. And so the alternative then tends to be, well, let me go ahead and pay cash. Well, 2 things are that with paying cash, you have to have first saved up the capital to be able to pay cash. So you need to delay gratification for the time frame that you're building up the capital. When you pay cash, you give up your capital and what you could have earned on that money. So now remember, we talked about a interest rate environment where you're earning very low return on your savings account. We also have many other options of where you would store that money. And just imagine you were putting your capital in a place where you could earn, say, 4 to 6% rate of return if you'd invested that money. As soon as you give up your capital, you no longer have the opportunity to earn that rate of return, and that is your lost opportunity cost. What this tells you is that whether you pay cash or whether you finance, both cases have a cost. The opportunity cost of financing is the interest that you pay. The opportunity cost of paying cash is the interest you're no longer able to earn because you gave up the ability to earn interest when you gave up your capital. Both of these cases, I want to illustrate something for you real quickly. So if you're in an event, a situation where you're financing, imagine this line that is a negative or a 0 equity line. You have 0 equity. And the person who finances is going into negative equity position. So they're going from having nothing, they're going down to a position where they're financing, so they actually owe more now, they're down here, than they own, and then they have to go ahead and pay back that loan. So once they get that loan paid back, they're back up to 0 equity. Then they may have another need for financing, and so they're going down negative again, paying back that loan and coming back up to 0 equity. And they're just staying flat. They're not actually moving forward or backwards. They're just staying flat. When we look at the person who's paying cash, they're not financing in terms of paying an interest cost, but let's look at what they're doing instead. So if this is your negative equity line, the person who's paying cash is first having to save up capital, so they're going above that equity line. They have some capital in their control here. And then they're going to go ahead and use that capital. And so they deplete their resources down to 0, back again at 0 equity. Then they're going to save up cash again, and they're going to store up cash over here. And then by the time they want to use that money, they're going to drain and deplete their equity down to zero again. So in both cases, we're not really coming above that zero equity line. And also, the challenge that's happening is when you're in a position that you have given up your equity, you're now no longer in a good position to obtain a loan and look for financing because you don't have the ability to show that you can pay that back. You have no collateral. So what is the alternative that takes advantage the best of both worlds and really blends them together in a way that puts you in the maximum position of control? I'm going to call this self-financing with a private reserve. We're going to combine some concepts and ideas together, and I really hope that you can work through these ideas with me and understand what I'm communicating to you. So in a position where we self-finance, what we want to do is we want to be in a position where we save up and earn uninterrupted compounding interest on our money. So this compound interest has been called the eighth wonder of the world, right? It is miraculous when you look at your dollar earning interest, and now the combination of your principal and interest is now again earning interest. And that interest is added back to the pool, and now you're earning interest on that again. And so as you continue to grow this pool of money, the longer time span that you get away from day one, the more you are accelerating. And so it's this exponential, huge, parabolic curve. What we want to do is we want to save our money and keep our capital in that position. We never want to give up our capital. We need to value capital. The reason that banks are one of the most powerful business organizations or business models in the world is really that they understand the value of capital. They control capital. So why can't we do what the bank is doing and control capital? So if we are in a position where we earn uninterrupted compound interest, we are taking our income or our capital and we're continuing to grow that with uninterrupted compounding, and we are keeping control of those resources. Now, that puts me in a position that I have collateral, right? So I can go to a bank or a financial institution and ask to collateralize a loan against my capital. So I'm keeping my money earning interest, and I'm going to finance and I'm going to pay interest to a financial institution, and I want to go ahead and use their capital. So why is this any different than just simply having your negative or zero equity line, going into debt, and then paying it off? Most people think that as soon as they take a loan, they're in debt. They are not. If you have collateral to back a loan, you're not in debt. Debt means a negative equity position. Negative equity simply means you have more liabilities than you have in assets. But if you have collateral, that is an asset. It is money that you have and you control. So now if I can take a loan against my collateral's here, I take a loan against my collateral, put a lien against my collateral, pay interest on that loan, I still have my capital earning, and I'm able to get a better rate of interest on my loan because I'm at favorable terms. The bank is looking at me and saying they're capable of paying back this loan, so I can go ahead and lend to them. The bank is thinking this is a lower risk environment because you have capital to pay them back. And so they're going to give you more favorable terms on your loan. So now I'm able to take the bank's loan with a better interest rate, and I'm able to go ahead and pay that off. And as I pay off that loan, they're going to reduce the lien against my capital reserves. So the reason I call this a private reserve is I'm in the position of controlling my capital. It is mine, and I am able to control this capital. I have access to it, and I can use it as collateral. Now, this is the most powerful position for you to be in because now you have options. Those options include financing from a bank or possibly another financial institution, or possibly using your cash if that was the best decision in the moment, or possibly taking out a different kind of loan. But it gives you options. Let's talk about the challenges if you don't have your own capital. What I see all too often people doing is saying, well, I don't want to be in debt, and I don't want to finance, and I don't want to pay interest. And so they get into this position where they build up the capital and then they go ahead and pay off all of their loans. And they're in a position with no loans, no payments, but also no equity, no capital. And the reason it's dangerous is that if you need capital for something, you have a very difficult time getting it because you're now risky. You're risky because you don't have the ability to pay off a loan, so a bank is not going to lend to you on such favorable terms. And what happens if you need capital tomorrow? You're either going to be required to go to the bank and get an unfavorable loan term and interest rate, or you're going to have to forfeit the opportunity. It's a very dangerous position if you have no capital. So the moral of this whole scenario, the best way to finance is to use a private reserve. This is where you store up your own capital. You never let go of it. You keep that interest compounding. Don't use your own cash. Use somebody else's cash and borrow using your capital as collateral. It's the most powerful position for you to be in, that you can control your financial destiny. Thanks so much. I'll see you next time. Hi, this is Rachel. I hope you enjoyed this episode of Money Secrets. If you did, like this video, subscribe to our channel, and leave a comment below. I would like to invite you to get your free cash flow generator to help you start keeping more of your money. Come on over to marshallsinsurance.com/cashflowgenerator to sign up.